Asbury has been a stock that has been on my list for a while. It's a car dealership group, but which also services them and insures them. And now lately the value has fallen a lot after the third quarter report, and I bought some shares. Today I'm gonna explain you why I think it's a great company with a good management, which is gonna have outsized returns in the long term. Here we're gonna look on the Q3 report. We can see they sold on some dealerships, so the total company revenue is down, but same store is kind of flat, which is good because that means the dealerships that they have are not declining. Also, what is great to see is that parts and services are still growing, because when it comes to their margin, this is where they make a lot of money. Financing has a bigger margin, but overall, when it comes to their gross profit, parts and services makes up with most. So I'm happy that parts and services is still growing. Of course, finance and insurance is down. Financing has just got more expensive, so less people finance. Online service appointments, when it comes to parts and services, they're having an amazing growth streak here, and it just looks like it's gonna continue. When it comes to the insurance segment, they have a benefit to other smaller dealerships. Because they are so big, most dealerships have a lot of third parties that deal with it. Here they have one standalone company which is dealing with it, which gives them a huge advantage over smaller dealerships. This is one of the reasons why smaller dealerships are dying, because companies like Asbury are just crushing them. They also crush small dealerships because they have something like ClickLane. And once again, because of volume, they're able to offer better service to the customers, more of an online presence, with which smaller dealerships just can't compete. That is the car dealership business, where they make a lot of money on the finance and insurance and the parts and services. They don't make a lot on the cars. And when it comes to growing the business model of Asbury, small organic growth and a lot of acquisitions. Nearly every year they have a big acquisition. Just recently in 2021, $6 billion in acquisitions. They also divest some of the revenue, but we can see overall they're a net buyer of businesses. They also buy back a lot of shares when they have the cash for it. Just recently they bought back $211 million in shares. The market cap is nearly $4 billion. That is a lot of shares bought back in just 1 year. And overall, when it comes to the share count, we can see the long term is a decline. Of course, in 2021, with the acquisition, they issued some shares, but they're already back to pre-acquisition levels. This enables just gigantic earnings per share growth. Normally, I like to use the free cash flow per share, but that is the issue in the car dealership business. The free cash flow is very unstable because of inventory changes. The free cash flow per share is way up and down depending on what time it is, what the inventory changes. Just recently, for example, they added some inventory, which made their free cash flow be artificially lower. In 2022, inventory was reduced due to the extreme demand and no supply. In this case, free cash flow was artificially high. That's why this is one of the companies where I think earnings per share should be a better metric. And they're already making their next acquisition, where they're buying Justus Automotive Group, which will add another $2 billion in revenue. And usually Asbury's acquisitions are very good for the company. They're very good for shareholders and create a lot of value. That's why I'm happy when this management decides to do another acquisition. Now, can they actually do this acquisition though? Do they have the cash for that? Well, they have $1.7 billion in available liquidity, which is not just cash, but also revolving credit facilities, etc., which is basically just a credit card for businesses. They will have to issue some debt, but at least when it comes to cash, they're not over leveraged here. And their debt maturity is very favorable. No debt matures in 2023, some in 2024 and 2025, but every other debt is only way afterwards. So they won't have to refinance at higher rates, and they can hold cash until then because it's very far away, which is something crucial for automotive companies. While it's less important for car dealerships, in the automotive business, there are big ups and downs. So if you're caught in a downtrend with a lot of debt on hand, not a lot of cash, then it's an issue. So even if a downturn happens, it will be beneficial for Asbury long term because they can buy out weaker dealerships, integrate them into their network, and long term, once again, create outsized returns. Now, they didn't have any free cash flow this quarter because of, like I said, the volatility in the free cash flow. We can see they added around $300 million in inventory net, which is something to watch out for. If they get too much inventory in hand, they will have to sell it off at a discount, but I think this is not too big of a concern yet. If they didn't have this inventory shift, they would have made around $250 million in free cash flow. So this is why I'm saying free cash flow is very volatile in this company. Next quarter, they could be selling off all that extra inventory, and they would have double the normal free cash flow. This is why you need to watch out for inventories in these companies. Otherwise, if you go for free cash flow, it could be very skewed, it could be a one-off, and you could be making miscalculations. But overall, the company is on a long-term growth trajectory. They can either do, like they did from 2014 to around 2020, small acquisitions, less revenue growth, but they buy back a huge amount of shares. You can see earnings per share nearly tripled until 2019, and then they came with the huge acquisitions, and EPS skyrocketed. I think this is gonna come down a bit, it's already coming down, but not by a lot. This is not a one-time off from the growth. They bought a lot of new dealerships. It's not gonna be following this trend, slow growth. It is gonna be somewhere around here. So what if we count with an earnings per share of $25, which is way below the 40 something that they have right now, but I want to be safe. It's the auto business. There are big ups and downs. 10% growth rate for the next 5 years, 7% for 5 years after that. This would only include 7% of the share buybacks that they're doing right now. That would assume no new acquisitions, which usually are very beneficial for shareholders, so only 3% organic growth. 50 multiple is way higher than the current multiple, but it's a very great business. It's conservatively managed, long-term, very great shareholder returns. That would give us an intrinsic value of nearly $300. The stock is currently at 187. That would be a 60% discount, but it could also even be better. What if we only have a slightly higher growth rate? They continue to make great acquisitions, which greatly increase earnings per share. Slightly higher multiple, $383 per share. Well, what if the car business gets slightly worse? They get back to $20 per share, growth rate of only 7% and 5% after that. They only buy back shares, basically no organic revenue growth. 10 multiple for a company that is not really growing, which is still around 8% of returns. So overall, I think this is a great risk-reward ratio, and I'm gonna continue to add to this company. It has a fantastic management, it is very shareholder return focused. What do you think about Asbury? Write down below. Have a good day.